Let's talk about bonds. Let's talk about bond characteristics. Let's talk about bond kind of funsy facts. Let's talk about bond valuation. That's the math, if you will, in my mind, of coming up with, well, why does a bond cost this and such. So a lot of stuff here on the, as always, right? My goal here is to give you kind of a highlights version and try to a distilled thing that might help you some in terms of knowing concept type questions that will be graded eventually for you, and some hints about the math as well. But when it comes to math, I think doing practice, practice, practice with an eye on, say, solutions and that sort of thing to check your work, and of course, contacting me if you're still kind of struggling with it is the way to go, right? But let's get rolling here and talk some about bonds, right? So the way that most bonds work, is that they're have a big lump sum par value. It's also called the face value, right? And it's the amount paid at maturity. Usually that's denominations are in thousands of dollars, sometimes hundreds of dollars, right? And that's typically speaking, that's kind of an amount to be repaid. And I'll explain that kind of here in a moment after we finish all 5 of these points on these 2 slides. I'm going to draw you a little illustration. Right? Your maturity is when the bond actually expires. It's when that big par value or face value amount is due from the borrower, who we say issued a bond. The bond issuer is just another name for a borrower, to the lender, who is the one who bought the bond. Weird thing about bonds, if you're brand new to them, is it's just a way to denote lending, right? But the one who owns the bond is the lender, and the one who issued the bond is the borrower. The bond, if you will, is kind of the contract that promises that the issuer will repay the lender, right, given a certain amount of money borrowed, and it spells out the timing of how it'll happen, along with other rules that go with how that's going to happen. Bonds will note the issue date when they occurred as well. They have a coupon interest rate, which describes how they pay interest. Right? And that coupon interest rate is typically quoted as a percentage, and that percentage is applied to the par value. So if you say that you have a 4% coupon rate on a bond, right, then that usually means the coupons would be $40 a year, assuming that $1,000 face value amount. The coupon rate is applied or multiplied, when you get to the math, by the par value to get an amount of interest that's paid. And say, I'll just get you out a little example here in a moment. And the yield to maturity, right, is a characteristic of the bond. Right? It's the rate of return earned on the bond if it's held until maturity. Right? And this is the case particularly if you consider the bond if it's bought when it's first issued. Not all bond buying is done at the time that it's issued. Sometimes bonds are bought third party, like I buy them from IBM, right, to lend IBM money, and they're going to repay me, and then I don't want that arrangement anymore. I'd like to cash out, if you will, and so I sell them to you. Right? So part of the valuation here depends on if we're talking about the original issuance of the bond versus later, and we'll talk all about that here as well, and give some examples, plenty of examples for you to practice and make sure that you can do the math and number crunching on this sort of thing. This is a picture of an old bond back when these things were actually held on paper. Nowadays, bond kind of holding and such is done electronically. It's safer that way, and you don't have to store them in a safe deposit box or anything like that. But you can even see here, this is a General Electric corporate bond, and it was issued, I believe, 1956. I'm trying to figure out exactly where it says that, though. And it was a 20-year bond because the expiration date here is due. That's the maturity date, 1976, May of 1976. 20 year. Oh, well, because it says 20 years. That's what I was just implying. right? So it was issued obviously in 1956. 3.5% there would be your coupon rate, and that applies to the $1,000 face value that's literally stamped on the bond. A lot of these terms actually come from when you physically had bonds, right? So 3.5% of 1,000 is $35 that would have been due every year in this bond, usually starting a year later, or a period later, excuse me, with a face value of 1,000, right? So that's where a lot of this terminology comes from, that sort of setup. And right, if you want to think of this way, usually what happens then is, right, the bond, let's say at time 0, we'll use that example, this 20-year bond, 0 to 20. In this example, it was from 1956 to 1976. Right? It pays, typically the way this works is, right, $1,000 is invested here, right, by the lender. Now, and then it's repaid here, right, by the issuer, GE. So GE, now if you take GE's perspective, right, this is from the lender, right? If you take GE's perspective, the issuer, this all flips, and it's plus 1,000 here, and they repay this amount here, right? But of course, no one would lend $1,000 interest-free for 20 years. That'd be nutty, right? So the whole point of investing in bonds, if you're on the lending side, is, oh, well, you have some sort of interest paid to you, and it's paid, right, every period. Say 3.5% a year for 20 years is $35 every year, right? And you get the final coupon right here. That's the most typical kind of structure for bonds, right? And you can see about the issue date and the maturity date and the coupon rate, but you apply it to the $1,000 par value at the end to determine the dollars amount paid, right? Of course, same thing here. These are minus. So when you're coming to do things like valuation of bonds, you can adopt either the perspective of the lender or the borrower, right? But usually we tend to do the lender because when you do the lender, your future value and payment are positive. That's how you're repaid, and you lend money up front. That's the lender's perspective, right? And then the issuer, which is the same as the borrower, flips this. They borrow money, they get a present value, and they have those. You can consider the valuation of a bond when it comes to crunch numbers from either of those perspectives. It's just a matter of being consistent. And again, with bonds, present value always takes one sign, future value and payment the other. This coupon structure is the common one that we have in corporate bonds. That's a fancy way of saying that the interest is paid every period, right? And that you issue, say here, and borrow money and then repay it all at the end. All right. Now, we'll get into more detail on this, and of course there's more in the book as well, but this sort of setup, especially where the $1,000 value right now is based, this is based on the idea, right, in this example, we're doing kind of a first blush here, right, the present value equals the face value, which is also going to be on your calculator, the future value. The 1,000 equals the 1,000. That assumes that the bond coupon rate was issued to match the yield. And that's generally how this sort of thing works. Now, the yield tends to be one of the most difficult parts of a bond to understand in terms of terminology. Your book's rate of return earned on a bond held into maturity, right? Also called the promised yield or expected return. All of that is true, but if you're new to bonds, I tend to think of this as a little extra. This to me is the easiest way to envision yield if you're brand new. The yield of a bond, right, is the prevailing coupon rate of our peers. When I say our, I'm taking the corporation's perspective. it's the prevailing coupon rate of our peers, right, bonds of identical maturity. It's basically saying, gotta get that off the screen. It's basically saying this is the going rate, right? Like, hey, this is the amount you pay per square foot for real estate here in this neighborhood, kind of thing, right? Well, if firms like me of my size that issue similar bonds, they have about my same risk, they're in the same industry, and they're doing 20-year bonds, just like I'm doing 20-year bonds. Whatever they pay, that's kind of the going rate, right? That's the neighborhood rate of what people are paying in coupons, people being my peers in this example, right? Usually what happens is that bonds are issued, right, with a coupon rate that equals the yield, right? You kind of just you have to borrow at whatever the market rate is. In fact, sometimes you even think of the yield as the market rate, right, for borrowing. A lot of this becomes more routine once you practice, right? But this is how things typically work, right? And I highlight that because when bonds are brand new, when they're issued, this thing happens where the coupon rate usually equals the yield, right? And then the math works out beautifully where your $1,000 that you raise for the borrower, or that's invested, lent by the lender, right, matches perfectly the maturity value or face value or par value, right? Face value, par value, maturity value. Those are all synonyms for the big lump sum here at the end. Yeah, those things match when the bond is brand new. But here's the key. Coupon rates are set in stone. Once a bond is born, if you will, the coupon rate stays the same forever and ever and ever. Right? Like the 3.5% was literally printed on that old GE bond. It can't change. But yields can change, right? So I'm actually going to erase here. Right? So coupon rates are effectively fixed. Now there are some exceptions with some weird kinds of bonds, right? But yields can change. Yields can change every day, right? The going rate of, right, coupons paid by your peers can change all the time. Tomorrow they might have to repay a little more interest, and that would mean yields are going up. Or they might not have to pay as much. They might be able to borrow at a slightly cheaper rate. Yields go down, right? The contrast between the coupon rate and the yield drives, it's not the only thing that drives the value of the bond, but it's a big thing in driving the value of the bond, right? And the value in particular would be the present value. Okay? So I'm spitting a lot of stuff there out at you, but that's large, and I don't necessarily expect all of it to take immediately here, but I kind of do it because if I get it out there and I start using some of these terms multiple times here as I go through the slides, I'm hoping that it'll kind of stick as we use those sorts of things. Okay? All right, let's kind of try to move on a little bit here at least and talk about some funsy facts with bonds, the call provisions. A lot of times bonds are issued and the issuer, like General Electric, we'll just keep doing that as an example. General Electric decides, well, what if I don't want to owe you for 20 years? I'd like to have the option to prepay, to retire my bonds early. Retiring bonds early is called calling them. When you call your bonds, you're effectively terminating the contract early to do so. Right? That's a concept type thing you might be asked about. Right? The call provision is at the choice of the borrower. And again, I kind of liken it to, an early termination provision. Like if you've ever had a lease where you could break out an apartment or something like that, or a phone contract that's supposed to be for a year or something, but you can break it, right? But usually when you have a ability to break a lease, say, it comes with an extra fee, right? And that fee applies here with borrowing for bonds, and it's called a call premium, right? So usually, not well, I shouldn't say usually. It's pretty common with corporate bonds. Sometimes they are, sometimes they aren't, right? But they have call provisions, okay? And that allows bonds to be retired early, right? But at an extra fee, right? And then typically speaking, right, the yields, which is the coupon rate as well at the time they're issued, right? The yields of callable bonds are higher than the yields of identical, except for non-callable bonds. Why? Because the callability of a bond is an extra freedom, an extra thing that the company can do, that the issuer can do. So they have to pay for it. They have the right to retire this debt early and get out of the contract for just a little extra fee, right? But to do so, they have to pay higher coupons, higher yield at the time they're issued, right? So it's sort of a choice. And as an investor, it's kind of your choice too. You can buy bonds that are callable and earn a bigger yield, but then you always have the possibility hanging out there that the bond issuer will call your bonds, right? And you won't be able to make those coupons for the 20 years, for example, that you're expecting. Or you can accept less of a return, less interest rate, right, on bond money that you invest. But simultaneously, right, you don't have to worry about the bonds being called if that's something that you fear. And when I say they're callable with the call premium. And the call premium, again, is kind of akin to an early termination fee. You have to pay extra when you retire this bond. A few other terminology things here, right? Convertible bonds can be converted into stock at the behest of the borrower, right? It's a power this time that's for the lender. Right? And there's different sorts of tricks and trades to convertible bonds, but that is a concept thing that I'd be familiar with. I'd highlight for myself a convertible bond, right? I'm trying to think what else to mention to you here. Let's see. Most of these other things are less common, right? These sorts of things, while they say every textbook you'd ever see on these things is going to mention them, they're not as common. Like puttable bond, say puts and calls, some of you might be familiar with, are financial opposites, right? So the name puttable bond is supposed to mean that the issuer can retire the bond. Like, I lend you money, but I can force you to repay me at any time, sort of thing. Right? Well, that's way less common than a callable bond, but it gets the name for that reason, call versus put. I'd say, again, of these characteristics that are highlighted in our text, I think the convertible bond is probably the one that I'd be kind of most aware of, although, again, I highlight these here because it's not uncommon to see these references in text and such like that. Right? Well, the basics and the whole reason that I spent a lot of time there, a couple slides back, in sketching out the terms of the bond, things like yields and coupon rates and maturities and stuff like that, is because if you can get your head quickly around the way that corporate bonds work, where the interest is paid with repeating coupon payments, 35, 35, 35, 35, doesn't that sound like an annuity? Doesn't that sound like an annuity? Yeah. And it has present values and future values, right? Wow. If you can get your head around that kind of structure, then, wow, valuing bonds is really a perfect task for like our financial calculator and for Excel and all that sort of thing. All right, so the really fun thing about this, and kind of the reason that typically in any corporate finance class, the teacher's going to want to quickly talk about bonds after talking about time value of money, is because while that skill set is particularly hot, it's really useful to talk about valuing bonds because it's such a perfect thing to do. It's such a perfect, you got the perfect tools in your toolbox after time value money to value bonds. Right? So we'll get to that. I am not personally as big on trying to parse out, right, the return on bonds. Like there's even devoted chapters in our text and stuff to describing even more detail about why bonds return the amounts that they do, and it's not that it's completely pointless or uninteresting, but it's not my favorite topic, trying to parse out why the pieces are what they are. But I wanted to sort of bring to your attention that I know there's more detail in the text if you're kind of interested. It's not something that I hit with a lot of don't plan to hit anyway with a lot of graded points either, right? So what's really common, and I was trying to lead us this direction here a while ago, what's really common is for a bond to be issued where the yield equals the coupon rate, right? And we said we wrote that up earlier, right? Right? When your coupon rate, which again is fixed at the time a bond is born, when it matches the yield perfectly, right, then the price of the bond, the value of the bond, equals its maturity value. Right? And that maturity value on your calculator is that lump sum that's paid at the end of this structure. Right? It's the maturity value or the par or the face value. Those are all the same. Right? And typically this is how bonds, right, are issued. And the coupon rate, right, is fixed, and the yields can change later. Now mathematically, what does this mean? It means, like in our example, right, if you have a yield of 10% and a coupon rate of 10%, it means that when you go to do the math here, and this is a 10-year example, so we're going to get away from that GE thing here for just at least a while, right? It means that, $1,000, say, is lent at the beginning, repaid at the end. 10% of 1,000 is 100, right? So the bond holder gets $100 every year in this example. Well, the reason that this present value equals the future value, it's not an accident, and it's not, it's a mathematical reason. And the reason why is because if you actually take the present value of these dollars that are repaid, it works out to be exactly $1,000 at present. What am I saying? I'm saying, well, all the $100, right, coupons that you're paid in the future, right, those are all discounted at 10%, and like always, you have to do it to the number of periods. And you also, of course, when you own a bond, you're going to be repaid that big lump sum at the end. If you go do the math on this thing, that's also to the 10th power. If you go do the math on this thing, it's not an accident. It works out to be exactly $1,000. Right? But the reason why is because if you issue bonds where the coupon rate equals the yield, right, then the amount that they're worth that you can borrow at the time you issue them matches the maturity value perfectly. And that might still seem sort of like, okay, but compared to what? Yeah, well, hold on that thought for a minute. Most of the time, and this is just literally showing you the numbers, $100 divided by 1.1 is 90.91. If you go all the way to the 10th and final coupon, 100 divided by 1.10 to the 10th is only $38.55. You can do this all in your financial calculator too, of course, right? You can do for each of these stuff like, N is 10, I is 10, future value 100, present value, and that was where you get the 38.55 right here. Like, you can do them that way, as like we had back with our TVM chapter, or, right, you can do them by dividing by 1 plus the yield to the nth power. Right? I don't spend much time sitting around and thinking of bond valuation as this formula, but this is indeed the formula. That kind of thing was actually more applicable a generation or two ago. Thinking about bond values this way. It's a lot easier nowadays to just use your calculator, kind of thing. Right? Say, you can even think specifically of, well, how much of the value of the bond comes from the coupons, that's the interest being repaid, and how much of the value of the bond comes from the repayment of the lump sum, right? So again, thinking back to this structure, with the red example here, well, yeah, why is it worth $1,000 today? Some of the value is the 10 $100 coupons you're getting, 100 times 1, 100 times 2, 3, 4, 5, all the way, you get $100 every year, all the way through time 10. Some of the value is in those. And then some of the value is in this big $1,000 you're going to be repaid 10 years from now. Well, you can consider those two things separately if you want, right? Here on your calculator, right, you can just find the value of the 10. There's 10, n equals 10. $100 coupons. The value of those 10 is $614.46. The value of just the $1,000 lump sum at the end is $385.54. But lo and behold, when you add those numbers together, ta-da, you're back at 1,000. And the typical thing to do, right, with bond calculator problems is you don't do these two pieces separately, right, and add them up to get 1,000. You do them simultaneously. That's what I meant a moment ago when I said, oh wow, the perfect tool we have now in our toolbox, our financial calculator, is the perfect thing to do, perfect thing to use to value bonds. That's the reason why. Right? The present value of the coupon payments and the present value of the lump sum FV can be done simultaneously and give you a value right now. And of course, like you see right here, the important thing to do is both your payment and FV have the same sign, right? I have 100 and 1,000 both positive in this example, and that'll spit out a negative PV. You could also put in negative values for the payment and the future value, and then you'd get a positive 1,000 PV, and you'd be taking on the viewpoint of the borrower instead of the lender. But it's more common to do it this way because you can just plug in positives. Right? Bond valuation is going to be done in end mode, right? But say again, it's a perfect setup for the calculator. It would never be an annuity due or begin mode, would it? Because then you would be repaying money that you borrowed immediately. Well, why would you borrow money? Why would I borrow money from you if I'm going to turn around and give it right back to you an instant later? I wouldn't. So that's the reason that bond problems are always done in end mode. We might start to hopefully give you a little bit better feel here for, well, what about other bond values? Now, coupon rates don't change. Like here in this example, right, this bond was issued with 10% coupons, and once that's the case with almost every bond, that's going to hold. But yields can change, right? I might have issued this bond, right, yesterday, say, but what happens if inflation goes up 3%? So that if my peers are going to issue new bonds today, my peers' new coupon rates on their new bonds is now 13. Right? Yields can change, coupon rates don't, right? Yields change, coupon rates don't change. Yields can change. What happens when they change, right? Well, you can see right here what happens when they change, right? Now yields are 13%. What happens when you go crunch the numbers in your calculator? Right? Well, right, I'm going to look for a present value. My coupon payments are 10% of 1,000, so that's 100. One mistake a lot of people make at first with bonds is they see a coupon rate and they want to put it in the percentage line. That's wrong. Coupon rates are used to get a dollar of payment amount. 13 here for 10 years. Right? What's my present value? There's the 837.21 in our slides. Right? This is less than the face value. Right. Why is it less? Well, I have two reasons for you. The first reason is, hey, we have the same payment structure, but now we're not dividing by 1.10. We're dividing by 1.13, right? And that's the case for all of our coupons and our big lump sum. Well, when you divide all these things by a higher number, what happens to anything when you divide it by a larger number? The amount goes down. How much does it go down to? Well, you don't need to sit and do them all piece by piece anymore with a little calculator. You can do it with a financial calculator and you get the answer. The value when you do all of that, it goes down to 837.21. Right? This is called a discount bond, as our slide there says. And knowing this terminology is really important. It's something that's a concept thing that gets asked about for points, of course. Right? When your coupon rate stays the same, right, but your yield goes up, now your present value is going to be less, right, than your face value. Your face, maturity, par value, but it's your future value on your calculator. And this is called a discount bond. Now in the real world, the reason is because nobody wants to buy these bonds of yours anymore. Right? Your bonds only pay 10% coupons, and 13% is sort of the going rate. So what happens? Right? People avoid your bonds. They want to go buy the others, like the newly issued ones, more, and that drives the price of your bonds down to a discount. Now, it doesn't really affect you so much as an issuer, because in your case, you've already borrowed the money. But for the but for the lender, this is a bad thing, right? For the lender, right, this is a problem. The value of their bonds went down. It works in reverse too. What happens if our yields, right, remember your coupon rates can't change, but your yields can, right? If your coupon rate is now greater than your yield, that's going to make your present value be greater than your future value, and this sells at a premium now, right? Now, mathematically, I don't think I have to draw it out for you, but that's because if you divide all of those hundreds by 1.07 instead of 1.1 back in the original case, right, the values of all of those future coupon payments as well as the $1,000 lump sum is now higher. And when you add them all up, right, the grand total, the present value is higher. That's what makes the bond sell for a premium. Right. There's also a name, too, for the original case, for when our coupon rate matches the yield. That's called a par bond. So par, discount, and premium are really the three flavors of bond valuation, and it's all based on comparing the yield to the coupon rate. The coupon rate is locked in stone and can't move. The yield is the part that can. Right? So there you go. Right? And again, like I just wrote down with you, I also, in my mind, equate this with, discount present value less than future value, par present value equals, premium present value greater than. Most corporate bonds don't actually pay their coupons annually. Right? So, of course, we have the tools now to know how to deal with that sort of thing on our financial calculator, but it does throw some twists, wrinkles into the valuation. Most corporate bonds pay interest twice a year, that is, every 6 months. Right? What we call a semi-annual coupon structure. That's how most, not all, but probably the good majority of them work. You have to make 3 changes to your bond structure. When you're doing this, you have to change the N, the number of periods, the yield, because when you quote the yield, you think of it as your peers' coupon rate on new bonds. Right? But if you're talking about your peers' coupon rate every 6 months, for example, instead of every year, then that needs to be adjusted, as well as the payment amount that you're talking about paying for your own bonds. Probably easiest to visualize this via example, right? So if we take the same sort of, let's do a 12% coupon this time to kind of give you something that doesn't line up with 100, whether the factor of 10, excuse me. If you have a 12% coupon bond, right, with semi-annual coupon payments, the 12% that you'll see listed on the bond is going to be the nominal or APR rate. That's very common. people will just say, oh, it's a 12% bond, and they'll mean that it pays 12% APR or nominal a year. But then they'll also turn around and tell you, oh, but the coupons are paid semi-annually, right? What does this mean, right? Well, what it really means, right, is that you have 20 of these periods, because it's 10 years, and every period you're paid $60 of interest, right? And it's divided by 1.05, right, squared, all the way through the end to the 20th, and you're still repaid the same lump sum. But when you do the math on this, it spits out 1124.62, right? What are the changes that I've made? I've doubled the N, right? Because if I have 10 years but 2 coupons a year, I get 60 of the payments. And like we talk about in time value of money, the N tells you how many PMTs you get. So you have 20 $60 payments instead of 10 $20 payments, right? But you're comparing this to not a 10% a year yield, but a 5% every 6 months yield. This is to provide an apples-to-apples comparison. The final amount is 1124.62. Well, like we talked about in our time value of money area, right? If you do this back with the annual numbers, right, you get a little bit different number. It's 1122.89. It's not that different from the semi-annual. The semi-annual is 1124.62. If I change that and pay 12% once a year instead of 6% twice a year, right, with a 10% yield, it's 1122.89. But they're not the same, right? So if you were in a multiple choice world or something, that's why it's really important to read the question and take note of how the coupons are paid. Another example here, right? Let's do a discount one, right? So this time I've got a yield that's bigger than my coupon payment. My coupon rate is relatively poor. Immediately for me, whenever I look at bonds, I immediately notice the coupon rate versus the yield, like we've been talking about for a while now. If the coupon rate's less than the yield, I know to expect a discount bond, which is one where the PV is less than the FV. That's the case here, but again, the numbers would be a little bit different if you didn't correctly do the semi-annual structure, right? This is a 10-year, 10% coupon bond with a 13% yield, right? So if we do this, right, 10%, the value here on this discount is $837.21. That's a little different than the $834.72. So again, it's important to take note of how the coupons are paid, right? Now the yield to maturity here is what we've basically been talking about. The yield to maturity is assuming that the bond is held all the way until the end. We mentioned earlier, back to the first part of our slides, that sometimes bonds aren't actually held all the way until the end. Sometimes bonds are actually retired early. They could be put where the issuer retires them early, or much more commonly, they can be called, right? A callable bond. And there's detail more in our text about sinking provisions, right, which is money devoted to early prepayment of bonds or buying back some bonds. There's other details, say, in our text as well on this sort of thing, but say for now, I should just note to you that the yield that we've been talking about thus far is the yield to maturity. It's somewhat common in bond solving, right? The first type of problem that you're asked to do is this kind of thing where you're effectively solving for the price, right? We've, to this point with the calculator here in this chapter, we've given you an N, we've given you a yield, we've given you a coupon payment rate that you can use in conjunction with your face value to solve for a present value. The other kind of problem is only really one other kind of problem that we typically ask in a bond valuation framework. And that's one where we now give you the present value and you solve for the yield, right? So you're typically doing one kind of math problem with bond valuation. to date, right now in my slides, you've only ever solved for the price. But it's pretty easy to go the other way and solve for the yield. Right? What if you have a 10-year 9% coupon bond with a $1,000 par value? And here's the wrinkle. This time I'm telling you what it sells for. I'm giving you the present value. Right? Well, the challenge when you're given the present value is you got to remember, present value takes one sign, payment and future value take the other. So in this case, you have a negative, right, for your PV, positive for payment and future value. You could flip this around. You could do plus 887 minus 90 and 1,000, and you'd get the same answer. The yield would still be positive 1091, but you always have to hold that relationship. And when you start solving now for yields instead of for prices, then you can't be sloppy with your signs. You have to be diligent about negative for PV, positive for payment and future value. And again, you could do it in reverse, but it's typically not. Here's another example, right? If you want to try, if I tell you that the price was $1134.20, solve for the yield again. The first thing that I tend to notice here, again, is the dichotomy, the contrast between coupon rates and yields. But this time my eye is drawn to how big is the present value. This one, I can see right away in my brain, that 887, that's a discount bond, right? Because 887 is less than 1,000. Well, what does that mean? If it's a discount bond, I know the coupon rate when I solve for it is going to be bigger, or excuse me, my yield when I solve for it is going to be bigger than my coupon rate. I don't know what it is, but I know it's going to be bigger than 9, right? Because I'm dealing with a discount bond, my coupon rate must be lower than my yield. And then here, when my eye sees right away that I'm dealing with a premium bond, where the present value is greater than the future value, I immediately know that my coupon rate of 9% is going to be bigger than my yield. So I don't know until I crunch the numbers what my yield's going to be, but I know it's going to be less than 9 when I crunch the numbers. This gets a little bit hairier, a little more to do when you start dealing with the yield on semi-annual coupon bonds. Again, practice on the math of bond valuation is a help, right? But the idea here is you still have 3 conversions to make when you're dealing with yield, right? Instead of solving for price. You still have 3 conversions to make. You always convert the N, right? So if you have 2 coupons a year, instead of 10 years, you'd have 20. And you still always have to convert the coupons. Well, it might be 9% a year, but 9% a year is $45 every 6 months, right? But this time the conversion of the yield comes at the end instead of the beginning. And here's the weird thing for folks when they get started. You have to multiply instead of divide, right? Back here when we were in the price world, right, here you were cutting your yield in half when it was an input. But when you're solving for the yield, when it's an output, you don't cut it in half, you go the other way. You double it. Well, you're doubling it because the yield that spits out of your calculator here in this example is a 6-month yield. But when people talk about yields, they don't talk about 6-month yields. Yields are always discussed in annual terms, so that's why you double the answer. And again, if you fail to do it this way, if you just act as if it's annual, the value is going to be close. 10 years, right? 9% coupons, $1,000 face value. Coupons are, excuse me, I forgot. The present value was 887. Is that correct? I always forget when I go back and forth. Yep, 887. If I solve for the yield directly, I get 10.912 in this case, right? Whoops, and that's a little, but 10.912 is a little different than 10.88. That's why it's important, and it's a pain, but it's mathematically wrong to just ignore the semi-annual structure. Like we were talking about back in our time value of money, it's not going to impact things too much on your financial calculator if you're doing things right, but you have to do the conversions to correctly get the exact effective prices or yields from a bond problem like any other time value of money problem. Right? Now we talked about callable provisions earlier. Right? It gives the bond issuer the right to early terminate a bond. right? They can call the bond usually for an extra fee, right? Now, when do they do this, right? Bonds are usually called, right? Bonds, actually, I'll even be bold in that, are only ever called at a premium. At premium as in the coupon rate is greater than the yield. It's the equivalent to refinancing. Like if you're refinancing a mortgage, when do you refinance a mortgage? You refinance a mortgage when the market rate that's out there goes down and your locked in fixed rate is now relatively high. That's exactly what happens with bonds that are callable, right? The coupon rate that the company pays is locked in, but the market rates change all the time, up and down every day, right? If yields go down, that makes your bond now a premium bond, and sometimes the company can refinance this, and mathematically it behooves them to do so. That only ever happens, of course, when the bond sells at a premium, right? If a bond gets called, it changes the math a little bit more, right? Now, with your N, you have to keep an eye on, well, when is the bond callable? And if you calculate this new value here discussed in the slides called the yield to call, you don't use the N, the number of periods away until maturity. You use the number of periods away until a bond is callable, right? And you also typically see that early termination fee applied in the future value of your calculator. Right? So via example here, and we'll keep it semi-annual, so this makes it sort of tough. What if you have a 10-year, 10% semi-annual coupon bond, $1,000 par? Right now it's worth $1135.90. When I see this price, I notice right away, oh, this is a premium bond. It must mean my coupon rates are rather high compared to the yield. Now they are, right? My coupons here are 10%, and the yield I see in a minute is just 8%. Right? What's the yield to maturity? Well, it can be called in 4 years for $10.50. Pocket that info for a moment. Well, the yield to maturity is 8%. Right? This is just another one that we did a minute ago. 10 years is 20 periods. Right? The price is $1135.90. Be careful to put in the negative. The 10% coupons means 50 every 6 months. You solve for the yield and get 4. You have to remember to double that because the 4 is a 6-month yield. You get out 8% as the annual yield. But you have an alternative here. What if you call the bond in 4 years at $10.50? The $50 here is effectively your early termination fee. Here's the alternative. This is the new calculation known as the yield to call. You ignore the 10-year maturity time now. You don't use that anymore. It's the 4 years until callability that's used for your time. So your new N is 8. 4 years till it's callable, 2 coupons a year is 8. Your coupons are still the same, 50. The price is what the price is, $1135.90. Be careful with your signs. The new FV incorporates the early termination penalty. It's $50 effectively. And when you run the math, you get the new yield of 3.5684. But again, that's every 6 months. Like always, if it's semi-annual, you have to deal with the yield. And dealing with when you're solving for yield means to double. Right? When you input it, you cut yield in half. When it's an output, it's doubled. It's all for being able to talk about yields in the correct way. 7.137. Notice quickly, by the way, that the 50 is still 50. When you quote a coupon rate like 10% coupons, the rate is, and it's twice a year, so 50. The rate is quoted relative to the par value. So the $50, right, you're not multiplying by the literal future value in the calculator. You're multiplying by the face value of the bond, which assumes holding till maturity. Right? So you don't tinker with the payment just because you're now dealing dealing with a yield to call. Right? The whole point of this from the corporation's perspective is it's going to do whatever's cheaper. It considers these two calculations. What does the corporation do? If the yield to call is cheaper, right? if your yield to call is cheaper than the yield to maturity, then you plan to call them. You can't do it yet because you're still 4 years away from the callability, right? That's the equivalent of planning to refinance, same as if you're planning to refinance a mortgage. Of course, with a mortgage, you can typically refinance at any time, whereas bonds have some sort of call rules or provisions where you can't do it right away. Okay. We talked about this a little bit earlier in the case of the par, where we talked about what portion of the value came from current yield, right, versus from the lump sum. But this is a little bit more of a detailed take on it, right? There's examples for you to try, right, for us, and then say practice and such from both the book and say from our website and such. But this is demonstrating that part of the investment holding in a bond comes from the coupons, right? That's your current yield. And part of it comes from the potential change in price in a bond, right? Now, as sort of a quick aside to this, and it's something that sometimes asked as a concept, right? For par bonds, this is like, for example, when newly issued. For par bonds, right, the yield equals the current yield, which is a fancy way of saying all of the money you expect to make for investing comes from the coupons. You know, you lent 1,000 and you're repaid 1,000 10 years later. So any return that you're making is coming from, right, the interest, the coupons. But sometimes if you buy a bond that's at a premium or buy a bond that's at a discount, the value in the bond, right, has changed away from its par, and it makes the math here a little bit more complicated. All right. Hold on, let me grab my cord here. I think I might have just kept you waiting there. Sorry. Didn't mean to do that with running down to get the power cord. Sorry. I cut it. I'm being too wordy here this chapter. All right. If, say in this example, you have a discount bond, the expectation is that your value of your bond will actually go up a little bit over time. Right? And there's a longer explanation to all of this. Right? The gist of it really, right, is that with a discount bond, right, your capital gain yield is usually, or is expected to be positive. With a premium bond, right, your capital gain yield is expected to be negative. Right? Now, the mathematical reason for that is that, hey, if yields stay the same, then as you approach maturity, the coupon part of the value of a bond becomes relatively less important, and the lump sum becomes relatively more important. Well, when the coupons are relatively less important and they're bad, with a discount bond, your coupons are low. Well, as the coupons become less important, right, the value of your bond goes up when their coupons are less of the deal. With a premium bond, where your coupons are a big part of the value, then as you approach maturity and there's fewer coupons to be collected, then it's actually, right, the value of your bond, your present value, goes down a little bit. Now this is getting pretty deep into the detail, okay? Pretty deep into the detail, but say you can actually see that for yourself. If you, for example, let's just show you one quickie, try to, right? Say for example, take this one I had in here, right? 887, 9% coupons, $1,000 future value, the yield's 10.912. If the yield stays the same, let's just leave the yield at 10.912. What if I go from 10 years to go to 9? What's my present value do? It goes up a little bit. And to 8, it goes up a little bit. Because as I approach maturity, these crappy 9% coupons relative to my 1091 yield are less mathematically a piece of the value. So the expectation with a discount bond like this one is as my time approaches maturity, the value is going to go up, which means I expect the capital gain yield to be positive. My current yield is cruddy, relatively, because my bond coupons are low, right? But I'm expecting the price to go up. If I reverse this and have like a coupon rate that's bigger than my yield, right? See my premium, now I have a premium bond. What happens is I continue to approach maturity. The value of these go down, right? Because as I approach maturity, right, I'm getting fewer of these really cool, nice, high coupons. More of my value is now tied to the lump sum that's still 1,000, whether I'm talking discount or premium. So the overall deal is my capital gain here I expect to be negative. I expect the bond values itself to go down. Right. All right, that's the idea. When you buy, I'm still worried about my charge here. Right. And there's a small chance I'll have to do an addended part 2 to this. Right. When you buy a discount bond, premium bond, or a par bond, you project to make the yield. You project to make the same thing, the yield. There is no right or wrong or better or worse. When you buy a discount bond, right, you have a worse current yield, but a positive capital gain yield. With a premium bond, you have a better current yield because your coupons are higher, but you have a negative expected capital gain yield. And with a par, you have no expected capital gain yield, and the coupons match the yield. All right. Now, and say, this is kind of I have some concept stuff about this. The whole idea with bonds and comparing the coupon rate to the yield is that bonds with a long time to go are riskier in terms of their value. And this is called interest rate risk. Right? So interest rate risk, right? Interest rate risk, right, risk is also called price risk, but I don't think our book uses that term much. Right? This is the danger of present value change as yields change. Right? Your coupon rate is locked in, but yields change, right, every day. As our peers do new things, market rates force them to do it. Right? That risk, that interest rate risk, is a lot bigger when you have a long time to go. So for example, let's do this yet again. Right? Let's keep using 12% and let's do only 2 coupons, 2 left, and we'll do a 10% yield to make it easier. All right, what's the present value here, right? 1034.71. What happens if I change the yield? If my yield goes from 10, right, up to 11? It makes my bond less valuable. It's going to go down in value from like 1035 to about 1017. I just lost $18 in value when yields went up. Right? Let's do that again though. Let's now have a 20-year bond, right? And let's have the yield go from 10 to 11. This time, with a 20-year bond, right, the starting value is 1170. What happens this time when I change the 10% yield up to 11? My value goes to 10.7. I've just lost $98. Right? In the first example, I only lost $18 when yields went up. Now I just lost $98 when interest rates yields went up, right? Interest rate risk is the danger of your present value changing as yields change, and it's much more, right, with a high N, with a long time to go. Now mathematically that's because a bigger part of the value of the bond is the coupons when you have a long time to go, as we've discussed before. And those coupons relative to the yield, that dichotomy, drives valuation a lot. Okay. All right, that's what this discussion right here is. A 10-year bond has much more interest rate risk than a 1-year bond. And you can see it really directly with prices moving. But the weird thing is people don't always think of the risk this way, but the reality is there's actually risk the other way too. There's reinvestment rate risk. This is more subtle, but if you own the 1-year bond, right, and I should actually even specify a little bit more here, right? The fear here is, right, yields, when yields go down, or yields go up, excuse me, your values go down. This is the fear of the interest rate risk when you own bonds. Oh my gosh, my bonds are going to get or go down in value when interest rates yields increase. Reinvestment rate risk is the flip side. Reinvestment rate risk is, right, when yields go down, I have no place to reinvest my money. I've only got a year until maturity, say, like in this case. What am I going to do a year from now if yields have fallen down to 5%? It's going to be time to and if I want to make my 10%, I can't get it anywhere anymore. That's reinvestment rate risk. Now, in reality, a lot of what people do to get around this as investors is they ladder their bonds. That means having, climbing a ladder. They have bond denominations of all different kinds, 1s and 3s and 5s and 10s and such like that, so that no matter what happens to yields, there's some good news and bad news priced in, right? But nothing's completely riskless. I mean, there's a trade-off between short-term and long-term, and reinvestment rate risk and interest rate risk are opposites. Again, I sometimes call them price risk for interest rate. But reinvestment rate risk and interest rate risk are opposites. Right? And again, that's why sometimes people do some of each. Right? Buy some short-term ones to limit the interest rate risk, buy some long-term ones to limit the reinvestment risk. Right? Do all bonds of the same maturity have the same price and reinvestment rate risk? Right? No. Right? Low coupon bonds actually have less reinvestment rate risk, but more price risk than high coupon bonds. This just goes hand in hand, again, with the actual math of how coupons and lump sums combine to give you the overall bond value. But to say, I've kind of removed, I don't know, as of this recording anyway, I've kind of removed this concept from one of my favorite things on our problem list. I do sometimes have a debenture in the list of types of bonds. That's the difference. That's a bond that doesn't have any collateral. Now, again, to me, to be frank with you, I don't really think of bonds and classify them in my mind with whether they're backed by collateral or not. So to me, I use the word bond, and I'm thinking of a debenture which has no collateral, but this is a specific vocabulary term, is something that I'd be familiar with, right? Subordinate versus superior or senior risk, it works the way you would think it would, which is, right, senior debt is safer. It pays back first. If there's any kind of default, you get at least some money back. And because of this, right, it pays lower coupon rates. It's not as good of a return. And subordinate debt, right, is all the opposites of these. It's riskier, right, because it's towards the back of the line if there's repayments made, and it pays higher coupon rates to incentivize holding them. Let's see, yeah, say a lot of times when bonds go default or fail, the bondholders at least get something back, but how much of it you get back is dependent on how subordinate versus how senior that you are. Let's see what else. The line between investment grade and junk, I think we've talked about this before, but I can't remember, is a big one. Triple B versus double B for S&P is the easier one. Moody's has this weird little A structure they always have. I think there's a lot of funds like charities and pension funds and endowments that are not allowed to invest in junk bonds. So there's actually a really big nexus here at this piece of the continuum, if you will. Bond ratings are kind of they're based on how much risk you have, and the more risk you have, the cheaper your coupons can be, the less interest you have to pay. It works just the same as personal household finance with FICO scores. The better your FICO score, right? The better your FICO score, the less you have to pay in interest if you take out a loan. It's just that rather than having a FICO score, bonds have bond ratings, and the worse that they are, the higher interest rates you have to pay, just like in household finance. Right? Where do those ratings come from in terms of risk? They come from kind of a combination profile of quantitative and qualitative things. So some of it has to do with, back to our financial ratios, especially the debt-based ones like times interest earned, your debt ratio, and stuff like that. Some of it's more of an analyst sort of macro level stuff where they consider the kind of risk that you have and what the outlook is for your industry and how much regulation you might be subjected to and things like that. Right? And then some of it is based, you could even have different bonds from the same company that have different levels of rating, because some of them are senior, so they have higher ratings and thus pay less interest. Some of them are subordinate, which means they have higher coupon payments, but they have less guarantee. So it depends on details within the bond contract, and that can even differ from one bond to another, issued by the same company to raise money. Right? And then you want to be familiar with those, and you want to be familiar with the idea of a sinking fund as well, which is a provision that has money set aside to provide or buy back some bonds over time rather than just having to retire or pay off the lump sums all at once at the end. It's a design to kind of methodically rebuy some of the bonds over time. Right? And I think that's at least a lot. We got, again, practice problems out there for you, as well as some of this will be helpful in terms of emphasizing, I hope, pieces of the conceptual things that can be graded as well.